Good morning, everybody. Welcome to the Flow Show. Hope you're doing well, and I hope you all have a great week ahead. Good morning, Kay. Good morning, Stel. How you doing?
Come on, the Hammers. Good
Come on, the
morning.
Hammers.
That was a good result. When's the final?
Great result. July the 8th. June the 8th.
June
the 8th in sunny
good.
Prague.
I'm guessing you're going to be there.
Flights booked, hotels booked, tickets to be advised.
Nice.
Yeah, it was a heavy few days. Let's put it that way. Amsterdam, it's not probably one of the best places to have a football outing. Lots going on, as I'm sure most of you know.
Nice.
How are you guys doing? All right? Good week last week. Lots of pips.
Yeah, it was okay. We got the election results here, and it was really, really good. The current here in Greece, so the current government basically is staying on. There's going to be another round because the rules have changed, and you need to get an absolute majority, 50%, which is impossible. But they got 40, and the next party got 20. So there's going to be another election in about 2 weeks where the rules are relaxed a bit. So it's going to be another 4 years for the current government, which is great. Good result for the economy, definitely. Absolutely, definitely.
Yeah, a bit of stability. That's what Greece needs after the last few years. How are you, Kay? How you doing, mate?
Premier League champions, mate. Premier League champion.
Oh, yeah, Man City. Well done.
Four out of...
Without having to kick a ball.
Sorry?
Without having to kick a ball.
Yeah. I'm actually pretty glad they made it. They won yesterday 1-0 because that wasn't their greatest performance. But happy. So the first leg of the treble is done. On to the next one. And yes, had a pretty decent week last as well. So I'm a happy man. And only 2 days here in the office, and then I'll be leaving for a week and a half back to my homeland. Well, homeland used to be homeland.
It's still your homeland, mate. Born and bred.
Yeah, well, I wouldn't go back to live there, but that's a different subject.
Cool. You have a great break, well-deserved break, mate. I should say as well.
Yeah.
Right. Well, let's get stuck into things. I'm probably going to defer to you about some of the moves that have been going on because I must have looked at a chart about twice in all the days I was off. But we'll crack on through the headlines and see what's coming up this week, and then we'll get stuck into the prices. I assume Kay's already, I don't know if you mentioned it last Friday, but I assume definitely mentioned it in the chat room, that the PBOC apparently will curb speculations on yuan rates when necessary, sending out the first torpedoes that they're keeping an eye on what's going on in the currency. Obviously, we've had that break up through the big seven and a bit of a rocket up to the 707s before a bit of a pullback. There's been some other comments out in the Chinese press as well. The China Securities Journal, which you can pretty much call a bit of a mouthpiece for officials, saying that the Chinese economic recovery will provide strong support for the yuan, and that yuan fluctuation will have a limited impact on capital markets. That's a limited impact until it does have an impact. So again, these comments are just early signs that they're keeping an eye on things over there. Was anything coming out last week about that as well?
Actually, that PBOC line came out right in the middle of the Flow Show on Friday. But there's a lot going on about in the G7 as well about, and I've spoken about that as well about de-risking from China. They don't use the word decoupling anymore because they can't. There's just too many interests in or too many reliance upon what China provides for the rest of the world to go completely decoupled. But now they're talking about de-risking, and that's what keeping the market on its toes. There's been a few headlines about China.
Chips and stuff,
chips and things. So the trade war isn't over. That's keeping the Chinese yuan under the cush right now. But then, I will quickly repeat, as I said as well on Friday, Euro's biggest asset manager, Amundi,
So we can assume they've already started to invest in China, because if we're hearing about it, they've already been at it.
likely, but you know, as with all those things, it may not have an immediate impact on the currency, because there's ways to invest, right?
Yeah.
You don't always have to buy a currency to invest somewhere.
Exactly. Now, just as we move potentially into a phase where officials are looking at the currency, it's probably wise to keep an eye on the midpoint that the PBOC sets every day. They last set last night at 7.0157. You haven't really needed to watch this for a while one's been doing its thing, but now the comments are coming. We'll keep an eye on that, because that can also be a bit of an indication of whether they're starting to think that the currency's gone too far. So if the rate, basically $1 keeps moving higher, but the fixes are lagging quite significantly behind, it has to be, I think, in a 2.5% band over the spot price. It just gives an indication that they are keeping a larger eye on it, shall we say. Now, over on the rate front, they kept their 1-year LPR unchanged at 3.65%, and the 5-year LPR unchanged at 4.3%. This is some of the lending rates that they can tinker with if they want to do some easing. They've been left unchanged for a bit, so nothing to see there. They still prefer to be doing other bits and pieces of fiscal measures and easing elsewhere, but no real change there as of yet. Coming over to Japan, and the head of the business lobby, Kaineran, said that this spring's wage talks yielded very solid wage hikes. And this year's inflation facilitated by weak yen, the energy cost rise, or was facilitated by a weak yen and the energy cost rise, but does not expect inflation next year onward to be that extreme. I noticed we got some pretty strong readings out the CPI on Friday, Kay. Any comments out from the guys over there about that?
No, that's the thing. I actually didn't comment at all on those CPI numbers, and he just said that he still expects the CPI to come back to 2% at some point this year, and that perhaps afterwards we could have a little bit of a spike. They are talking about the review of the policy over there, but he already said that early 2000s that may have been overdone what they did then, but he didn't comment on anything that happened on over Abenomics. So it's all still a bit vague, but the one thing that he does is that he continues to communicate. So again, it's likely not going to be coming with shocks, although we know, I mean, any change in Japan will create some flows and stuff, but he hasn't given us anything to tell, oh yeah, we are going to do this or that. The rest, it's all speculation. Now there's speculation going on that they might shorten maturities, but that's already in the market. So I don't know. For the time being, I think status quo, and yeah, we just have to note. But there were rumors that those numbers were going to be high, so that didn't. It had a 40 pip or so impact on dollar yen when it came out. So that's about it.
Yeah, cool. Thanks, mate. In the UK, apparently nearly half of UK firms are going to defer investment due to tax rises, according to a survey from accountancy firm BDO. They said 46% of business surveyed with a turnover of between 10 million and 300 million pounds reported that the rise in the corp tax would delay investment. 39% said it would slow hiring or lead to job losses. this will be something that the government will keep a close eye on. They hiked the corporate tax from 19% to 25%, and it hasn't gone down well. That's one of the things that could impact the economy further down the line. But, you know, some of these businesses, they make big noises about tax rises, as anyone does, as a way of trying to influence political policy. But we shall see if that actually happens. But it could be something for the Bank of England to keep an eye on as well. ECB's Lagarde said that the ECB still needs to have sustainably high interest rates in the Eurozone, and that the ECB needs to buckle up and deliver on its inflation target. ECB's Schnabel said we will have to raise rates more and stay at a high level for some time. So keeping the strong rhetoric over there. Fed Powell was out on Friday and said inflation is far above the Fed objective. The FOMC is strongly committed to returning to 2%, but rates may not need to rise as high given the credit stress. Recently, it has been the case that markets are pricing a different rate path. So far, data seemed to support the committee's view it will take time to lower inflation. But they have not made any decisions on whether rates are sufficiently restrictive. Now, that doesn't sound overly hawkish. It sounds like there's more doors, or the doors open wider for a pause in June. Even some of the hawks are on board with that. Fed's Kashkari said that he's open to skipping a rate hike in June. And some economists on the other side have pushed back expectations for Fed rate cuts to 2024. This is from the National Association for Business Economics. They had a poll, and they were expecting cuts from Q4 2023. They've now been pushed back into Q1 2024. But I've been thinking about this stuff, and particularly the Fed. I wonder if this debt stuff is now, well, it would have been firmly in their minds. I wonder if it's becoming even more firmly in their minds regarding maybe going on hold in June. What do you guys make of that?
That's a good question. The thing is, the debt ceiling is going to be resolved eventually. And as I saw one of Joseph Wang, Fed guy.
Yeah.
I follow him. He has some nice points every now and then, and he was talking about that how the Fed, even if the debt ceiling isn't raised, at least initially, the Fed can prioritize payments. The government can prioritize payments, so they can prioritize bond coupons and repayments and all that, and then stop or maybe limit other stuff, or maybe replace payments for Social Security and stuff like that with other instruments, and there's all sorts of magic they can do to defer stuff for weeks and months even. So will be a resolution, and even if it looks like we get to a point where the available cash is not enough, or it doesn't look like it's enough, they will find a way to make it enough until the resolution is reached. So my view is that it remains the same. They're going to find a solution. Hopefully, the solution meaning they're going to raise the debt limit for the 157th time, whatever it is, and hopefully they're not going to let things go to the edge once again and do it earlier. But I don't have my view is not changing on that. Definitely.
Yeah, I think we're creeping close. We're obviously creeping close to the edge. I think we spoke about it last week on the Flow Show, what they might do. Yes, Brand says, how about disability and stuff? Yeah, things like jobless claims, the payments for those, all those sort of things. Pensions, I don't think they're called state pensions where you are, but there's big pension programs for ex-civil servants and that sort of thing. They will get paused and the money diverted. They've got, I think, 92 billion left of the emergency measures that they enacted since back in January. So they're chewing through the money. But what would happen is that all government offices, or a lot of government offices, would shut down. People wouldn't get their paychecks and so on and so forth. We wouldn't get the data. which means neither would the Fed get the data. So if we're running this, if we do enter that sort of stage, we're not going to get all the main economic data, NFPs, jobless claims, CPIs, anything that comes from a federal office, we won't get. So that's why I'm starting to think if we do go into shutdown, the Fed might use that as their excuse for a pause, because, well, I doubt they'll be getting the data anyway unless someone's slipping them stuff under the table. So it's going to be a nightmare for markets and the Fed to judge what the economy is doing at this time when they want to keep rates up.
That's a very good point, mate. Very good point, actually.
I still think there will be a solution, or resolution, but we're getting closer and the market's going to get more antsy about it. And the longer it goes, the more chance we have of entering that shutdown. And then we'll have to deal with it. So knowing what we have to deal with it in advance will hopefully help us with our trading, which is the main point. Right, coming on to some of these other headlines, geopolitics and all that, and on the debt stuff. Biden apparently met with what they're calling the Quad leaders on Saturday as part of his G7 shindig. Nothing much out of that. Biden says the discussion with Republican McCarthy went well and they'll talk again today. There's still this to and fro between all the leaders that not enough's been done, blah, 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 blah. So we're still in the thick of it on that front. Now, Yellen apparently told bank CEOs that more mergers may be necessary. That was a sources piece coming out on CNN, obviously to do with all the banking stuff in the US, small banks and whatever. So we might expect some further headlines there regarding some banks in trouble and some of the banks swooping in to pick them up. As mentioned a bit earlier on the China front, they did a security rule of US's Micron products, and they've now barred some purchases. This is a bit of the tit for tat stuff, as we mentioned, going on between the US and China. Obviously, the US Commerce Department came out and said we have firmly opposed restrictions that have no basis in fact, which is pretty much what the Chinese said when the US accused them of the same thing. So they're still playing their tit for tat games, but there has been, you could say, slightly more bullish comments. China's foreign ministry this morning talking about the US president, saying he's seen a shift in ties with China and that talks could come soon. The foreign ministry urges the US to have the right understanding of China and meet China halfway and bring bilateral relations back on track. The commerce minister has met some US companies in Shanghai today and will continue to welcome US firms to develop in China. So you have to take all these comments with a pinch of salt. You know, 1 minute they're barring firms and products, the next minute they're having meetings with them. But doors are being closed, but not locked shut. Let's put it that way. Might be the best way to do it. And another thing to think about with China is that they've apparently flipped to being an overall importer of refined products on things like oil. For a while, they were mainly exporting, but now they become a net importer. That's happened back as far as early May, I believe, just checking some of the previous stories. So that might be another reason why currencies like $1 are rising, if they're obviously buying US products or oil and stuff like that in dollars. They may need to do some FX on that front. That's probably just a drop in the ocean of part of the moves, but they're nevertheless. And lastly, the ECB has apparently urged investors to ignore all the noise from all their media leaks, I should say. As you know, there's tons of sources pieces we get out, particularly surrounding the ECB meetings, including the obligatory sources pieces a couple of hours after each announcement. Some ECB research found 368 instances of newswires revealing information from central bank insiders. And apparently the ECB have told us all to ignore the noise, even though some of those sources pieces move the market more than what the ECB announcements do. This was something Lagarde has been trying to crack down on with limited success, hasn't she, Kay?
Yeah, but okay, this leaks story has been going on since forever, right?
Yeah.
Remember when Draghi was on there, it was actually a story of leaks more than the story of central bank meetings. So yeah, well, I think it's going to be they can rein it in a little bit, but I don't think there's going to be a lot of changing there. There will always be sources. There will always be some form. Okay, they can try to rein it in, but yeah, that's it. But to come back a minute on that debt ceiling thing that you were talking about, I think the meeting between McCarthy and Biden for the market, short-term market, is going to be relatively important, because yet again, where on Friday we had the staff meetings were not going well at all. They came all out of the meeting saying like we're absolutely nowhere further at all, and then we had sorry, a setback in the dollar on the back of it. But then Biden and McCarthy seem to have had a good phone call when Biden was on his way back from the G7. So I think the market is going to attach quite a bit of importance to today's meeting. If I'm correct, it's 6 p.m. Eastern time. Is that the time where it's slated for? I mean to have seen something.
I couldn't tell you, mate. I haven't seen.
Yeah, I think I mean to have seen something, because if it's 6 p.m., that's too late for us, and that's going to be for the Asian markets to tell us what they think about it, and that's not always the right thing that happens in Asia, right? So there's interpretation and translation. Yeah, it's going to be it could be a funky one when we wake up tomorrow morning. Yeah, that. I still think they are going to find a solution as well. It's still the base case, but if they would actually find it, not all the details probably today, but if they would come out of the meeting saying that, all right, we're set to not to go on any shutdowns and whatever, we may see a pretty hefty reaction. Whether it be lasting is a different question, because my overall view is that we are still in those broader ranges in the market, but we may have a pretty hard reaction in stuff, especially in risk pairs, right? Like the yen or so.
We've been talking about this over the last few weeks. You know, different expectations. If it's a short-term can kick to September, the market may not be overly excited about that compared to a 1 to 2 year can kick. But I think that the closer we get to the deadline, I think the greater the reaction, even on a short-term can kick, will be, because the market will have relief, whatever it will take, whatever relief it can get, that there isn't going to be a problem in June. So I think
it's always going to be short-lived, and I think if it's only a can kick to September, if it goes to the wire, I think that's a short-term blip and then a pretty big reversal. I can see that happening. But Stelios, can I ask you a question about what you said? Yeah, about what you said about liquidity.
Yes.
You said that if they come to an agreement and there's no shutdowns and whatever, you were making a case of that's going to be a massive add in liquidity. Where does this add in liquidity come from, in your opinion?
Well, in the short term, the argument is that there's going to be tightening in liquidity because they issue more bonds and dollars get exchanged for the bonds, right? But the question is, do we think that as the debt ceiling gets raised and more bonds get offered by the Treasury, do we think that the Fed is not going to buy any of them? That's my question. I think we're going to, obviously in the last year or so, we've had quantitative tightening, so the Fed is actually getting rid of the balance sheet. But in the more medium term, I'm not talking about a week or a month from now, I'm talking about further out. If they raise the debt ceiling by $1 trillion or by whatever it is, there's going to be more monetized debt in the future. That's a given. because we have that's my argument, that because debt is going to get monetized, we're going to get more liquidity in the system, more money getting, being printed, if you want to call it like that, and we go back to the status quo before the QT started.
Okay.
That's my argument.
So that's going to be a thing that's going to be, we're going to have to look at in towards the end of the year or so. Not
Yeah.
All right. Okay. No, I misunderstood you when you said about the adding liquidity, because I'm like, my brain is still with the treasury issuing more bonds, and but the thing is as well, and there I think the move in interest rates may be of a shorter term impact, because if you raise the debt ceiling, and if they agree on like maybe some spending cuts on the one hand, but then on the other hand, Biden will want support for his infrastructure and everything. If they manage to find an agreement there, then I also think, and that more rejoins what you're thinking as well, is that the rest of the market is going to be more interested in buying bonds at those prices, because they will have a pretty decent guaranteed return, right? So then I think we'll find more buyers of US debt again, and there I can join your opinion. Still, I think if we bring it back to FX, it's going to be a pretty decent boost for the dollar in the short term if they get a decent agreement. That is,
in the very short term, I agree 100%. But the question is, we have the US generating what is $1 trillion plus deficit every year. Okay, maybe in the last year they're doing QT, so they're not buying up the debt that they're issuing to cover that hole. But as long as that's the case, and we have this deficit, there's no way that the amount of dollars in circulation is not going to keep increasing, exponentially. And I agree with you 100%. In the very short term, of course, it's going to have a tightening effect. But if you look further out, I mean, it's not good. I mean, I can't see any scenario where this is good for the dollar. But
don't forget, there's one thing that they have in their favor, and that's inflation. Inflation helps inflate the debt away, as you said. So that's something they haven't had for the past 10, 15 years. So yeah, there's always different ways to look at these sorts of things. But good comments, guys. Good thinking.
Yeah.
Well, just going to take a quick look at what's coming up this week, because we do have some key data points. We start getting the flash PMIs from tomorrow on the composites. We get some housing data in the US as well. RBNZ out on Wednesday morning or Tuesday night, Wednesday morning, whenever they decide to have it. Expectations are pretty split there. There's some in the market still perhaps thinking they might go a 50, although they're favouring a 25 pip hike over there. And the big data I'm waiting for is UK CPI and PPI, which comes out at the same time on Wednesday too. That is potentially going to be a real big number for the pound with regards to what the BOE are going to do. With some of the market now thinking rates are going up towards 5%. Some people think they might have one in the pipe left, or maybe close to a pause. This data is probably going to sign, seal and deliver a hike or not at the next meeting. So that's going to be a big one there for the quid. But we'll look at that in more detail later on this week. FOMC minutes, as usual, I'm not sure what extra these will add to the equation, considering we've heard from every Fed member 20 times over since the last FOMC. Even people like Kashkari now seem to be changing their mind from where they were a couple of weeks ago. So we'll keep an eye on it. You never know. Over into Thursday, we get the next round of GDP guessing, Germany and the US. And some more housing data pending home sales. Friday, Aussie retail sales could be a little bit of a mover for the RBA. And again, more UK data from retail sales there as well, which might be some icing on the cake for what's ever happened from the CPI report there. Durable goods can be a big number there, looking for those core goods there, and whether there's been any big ticket items coming out of that. Gives us another look at what's happening potentially in the manufacturing retail sector, that sort of thing. And then I think that's PCE on the Friday, where it says personal incomes and outlays. So is that going to match what we saw from the US CPI, or is it going to take something away from it? So lots of bits and pieces to look at for this week on the data front. Should keep us entertained, unless the US go and shut down, and then we'll get none of it. Right, let's crack on into some prices. So I'm probably going to defer to the guys here because I'm just picking up the pieces. But what I have seen this morning is that we're holding below the zone, one of my old zones in euro dollar. Again, this is one of those areas where, you know, it can do something, it can't do something. As you can see, it messed around a bit previously, messed around here previously, and now we're holding below it. And no surprise to see it have a move down a bit lower as well. What for me, what's been the main driver? Has it all been the debt stuff kicking off, and maybe some higher, or some of the market coming round to the Fed actually going to be holding rates for longer? What's been the theme?
I think it's a combination. First, the rate cuts have been pushed out. We used to price 75 by end of January, if I recall. Now it's more like 50 or just over 50. But the main mover last week, I think, was positioning. I mean, there's you saw stocks, right? We've been talking about the S&P.
Yeah.
Oh my, you know, if you're short, you should be worried. I've been saying it for days and days and days. Well, I think the market was caught a little bit short. We squeezed to 4,200 in the S&P. I still think the path of least resistance is probably to the upside, and the same with the dollar. And weirdly, you know how it is. If stocks rally, the dollar usually sells off, and vice versa. Well, this time they're both rallying, and I think the dollar also has been caught a little bit short and squeezing a little bit higher. And could we get to 104 or 104.5 in Dixie? I think we could. But I think combination of these two factors, and maybe also people talking about the debt ceiling, if it does get resolved, how it's going to be a tightening liquidity in the very short term, maybe positioning for that. I don't know, but I think combination of factors. What do you think, Kay?
Absolutely. It's like the other one used to say, it's complicated. There's a lot of stuff going on, mate, at the same time. And the effect is, as Stelios exactly said now, it's pushing yields higher, and it's pushing the positive vibes of stuff being possibly resolved, and the market being short equities all the time. We've seen, unfortunately, the retail community as well being very short equities, and this so many things, different things driving it right now. If you look at dollar yen, there's definitely expectations for the Bank of Japan to do something, and a bit of a gradual reprice there. Market short dollar yen, market long yen through process probably, and they've all been flying. A bit of euro, I read as well, over positioning, and then having, but we've already spoken about that, having rejected that 111 again, they needed to think again. But if then you look at the equity markets, that's another push for a slightly weaker euro, because euro through the process is a bit of a risk currency. When it's risk off, euro tends to strengthen versus antipodians and things, and that's all been not undone, but all the positions had to be adjusted, and it's all happening relatively at the same time. The only one where I'm not going to say is a mystery, but it's Swiss franc really still keeping very, very strong. So I suspect S&P is still
messing around,
because we've seen their reserves coming off over the past months, and they're probably still messing around there. So, but we are starting to get to levels where it might start to be interesting in Swiss franc. But I'm not there yet. I'm really going to wait for the S&P to tell me that they are done, or at least that they are happy where everything is at right now. But yeah, it's a big combination of factors. Even today.
Do you think that this debt stuff, the US stuff, is overshadowing everything else?
Yeah.
The BOJ, the ECB, the BOE. Is it something we need to be on watch for, that if this does get resolved, those forces will come back into the market? We could see euro rallying again.
I think there's a lot of major players who are just handling their day-to-day business, but wait for the debt ceiling to be resolved or blowing up, and yeah, that's basically it, and for the rest, I know it's micro things that move currencies between one another. And I was going to say, even today, if you look at, for instance, the Mexican peso is under pressure, which is counterintuitive with a positive market, and Banxico having had kept their rate still. But there is some logic in there as well, because if you look at the dollar rand is lower than, so I think there's again some cross playing going on in that in that field as well. There's a lot of micro things going on, with the macro environment overshadowing and keeping really the market for going into bigger moves and trying to create new trends. So as I said, it's if you want to trade stuff right now, I think it's hard to trade for longer than a few sessions, unless you have like your really long-term stuff on the books. But for the rest, it's more still like an intraday market, and or a couple of sessions than really taking big directions right here and now. But the once the situation will be sorted out, I'm sure that we are going to reattack some trends, whether it will be higher dollar, lower dollar. We will see.
Yeah. So for me, dollar yen is obviously one I've been keeping a close eye on. I've been short. I did have opportunities when we were nudging down in the 134s to maybe take some off, but I stuck to my guns. The only thing that's keeping me, I wouldn't say sane in the trade, is that we're yet to break out this 138 area and hold it properly. We've had a go. It didn't last. We're still back below, but we're not far from it. I think it's going to need to take a proper hold of this if we break above it, so this 138 area to become real proper support, and then we're potentially heading up, I'd say maybe even up to the 140s again. But if we can't do that, then we're going to stay in a box and maybe have a little look back lower. I wouldn't obviously less comfortable with my shorts now. Partly those were on for the Bank of Japan, and that story's not in the market side at the moment. I might flip or put on a separate long if we get above that 138 and hold it. But I'm not convinced of buying it up here for now on that basis. And he was asking about Aussie dollar. I noticed this one came within half a pip of my take profit that I left him when I left the office last week. I had it in at 66.05, and we missed on that one. It is still looking fairly weak. I don't see any reason why that changes for now. We had that move down to the 66s, had a bounce back up to this zone, couldn't get through it. So, the areas are showing up again. So, yeah, I still think there's further downside due on this one. We are making lower highs on the bounces. We're still making lower lows. So the short-term trend at least still remains in play. And I'd expect to move at least another test of that 66 handle down there. Euro sterling, I notice, is not making any headwind down below that 87. Sorry, mate?
Probably where you left it on Tuesday.
Yeah. Exactly where I left it, I think. Sorry, mate?
I say yes. Oops. I say yes, it must be there, because it just went. It just goes 25 pips above, or 25, 35 pips above or below 87, and we are still at 86.90. So it must have been there.
Yeah. So that's going to be encouraging for bottom pickers. Although the bounces at the moment are looking very weak. There's again another series of lower highs, which suggest the pressure remains bearish on here. But it's going to need to break and get under and hold under that 86.70 zone to bring some downside. If it can't, the longer we find support down here, the greater the chance that we see a bounce back up. But as mentioned, we do have some important UK data this week that could be the decider for rate moves, and that could be the decider for this one in terms of where it wants to go. If we get soft CPI, like a real big drop in CPI and PPI, then I'd expect this to be back above 87s, maybe even challenging back up towards the mid to high 87s pretty quickly after, because the market will be likely pricing in the BOE going on hold. I don't think they will. I still say 5%, but in terms of trading, yeah, this could become a significant bottom, or we get strong CPI numbers and we're trading down towards low 86s shortly after. So keep an eye on this one. It's been doing nothing, but it could do something later this week. Gents, who wants to take it?
I don't know. I can take it today, unless Stelios really wants to show something.
I don't have anything. I can do it tomorrow if you want.
Yeah, all right, mate. I'll go for it then.
Yeah. So maybe save for Wednesday, because when K's off.
Yeah. Okay. Well, whatever you guys want. Yeah.
All right. Okay.
Pass the baton.
First of all, euro dollar, and you know, I showed this one on Friday. And by the way, Ryan, Friday I had my own little disappointment. I went the dollar China went to 5 pips from my take profit at 707.50, and I think they printed something like 707.46 or so. And then afterwards I got stopped on my trader in the 703s. Yeah.
Yeah, well, I got done on my quick short attempt at 7. That didn't last long. But I'm still long a bit from the prior long. So that's done nice.
Yeah, so this channel in the euro dollar, if you look at it, the broader channel in the euro dollar, I spoke about that on Friday. It's finally a couple of pips through it, but then it's let's say it holds, right, and that's going to be your level again. I think 107.5. There's still more levels to the downside, but I think it's big enough. And if we start to confirm through 107 quarter, 107 and a quarter, call it, then there may be more to it, because there are some people looking at this 105 to get ultimately tested. But you know, for as long as this holds, we have to say that we are in broader ranges, right? And until something breaks, we don't have to look for more than what really is there. And for the time being, I reckon we should really still think about this little zone here. Okay, the trend line is going to go up. So the longer it waits to break really below, the less weight it's going to have. So I think we need to look at these Friday lows, 107.60s for your first point of measure, and then the 107 and a quarter. On the top side, Ryan already showed that we need to get back above this really short-term 108.35.50 zone, and then your 109 is going to start to show up again, right? But I mean, if it goes up there, then it's really going to be a flip of the coin. Are we going to go back to 111, or are we going to go for a retest in the 107? So there is room for anything. But as I was saying in the room this morning, I'm still not overly impressed with the bounces, although we're holding pretty well now in the 108. And I reckon there's a bit of help there from stuff like euro yen perhaps in there, and a bit of a bounce in the euro Aussie. But for the time being, I'm really neutral on the euro dollar. Cable, you know, 124, 40, 50. We're still here, and I think that must have been the level where you left as well, Ryan, on Tuesday. So we just can't get further than 40, 50 points away from this zone. It's still magnetic. It's still a level of very short-term decision-making, 123.90, 125. The figure is really, those need to go to create those bigger moves and perhaps coming down here or back above there. So that is really, I think those dollar pairs are, there's a lot of, we don't know what to do with the dollar right now in there. And we are pretty stable, give and take, where the flows will take us, because regardless what the players want to do with the market, there's flows going through every day, corporate flows, sovereign wealth fund, whatever, asset managers who need to manage their books because they get investments, they get divestments, so they need to do stuff. But for the time being, this is really a market which can't find its direction, and I reckon we will have to wait until we get a debt ceiling solution or rejection. Yeah, sterling yen still trying, but for the time being failing to break above the prior highs. So that's still your level. On the way down, really the bigger ones are going to be in the 168. I don't really know what to expect from yen crosses, because I had a quick look. Also, if you look at the whole month of May, the Japanese 10-year JGB hasn't been moving much, and the market is waiting for Ueda. But we could also say Ueda actually managed to calm down some of those market speculations, and for as long as we are not going closer to push up against this 0.5% again, there is little reason, I would say, on the yield side, on the JGB side, to pick a clear direction on the yen. We know that the Nikkei in turn has been pushing higher, and that is somewhere the correlation we've been talking about, those correlations, and that is also keeping the yen a little bit on the back foot right now. So that's your 137.5, 137.75 I mentioned before. This was your break of the channel, retested, probably done a couple of really weak stops under there, but we have to note that at least 137.5, the 3/4 is watering down right now, but this is holding for now. So 137, 45, 50, keep an eye on that one for as long as it holds. I'd say start of the week, not a lot of data out. Probably it's going to be down to Biden and McCarthy to show us the direction for this one once their meeting is done. If we start to break back above 138, 15, 20, we may push a little bit higher, but I think ahead of the meeting, there's very, very little reason why we should actually push through those levels here as well. The next ones above is 139, 60, 90 for me. So, and if we start, on the other hand, to go back below 137 figure 10, then the party may be over, and we may be in for a retest of the bottom end of the channel right now. The cloud is pretty far away. It's hanging around here somewhere. So daily cloud is not really a big indicator right here and now. Yeah, yen crosses pretty much the same. But again, as I was saying, Aussie yen may have a bit more difficulties than the Kiwi yen, for instance. Kiwi is a lot more resilient than the Aussie right now. One of the reasons is probably that the market is waiting for the RBNZ, but it's been a how shall I say, a theme of the last week and last week, let's say. Once we had this big impact out of the way of the lower New Zealand CPI, the Kiwi really rose again. So this one, if there's anything going wrong with risk, I think this one has more potential to get down quickly. Keep an eye on, by the way, on 92.30s if it would get up there. Then this one has a completely different look to it, because this one really actually broke above a level, retested it, perhaps some short-term stops, and we're actually holding pretty well in those 86s. So this one has a different look. So if there's anything positive coming out, I'd say this one maybe could push up a little bit more easy than Aussie, for instance. And this is what I mean by the Kiwi being much more resilient than the Aussie. Look, this is really a pretty steep drop, and it's starting to look like a trend now as well. So we are on a little bit of support here, but if this story continues, we will have to see after RBNZ, of course. RBNZ can easily disappoint the market as well. They have been acting a bit like a weather vane over their latest meetings, so it can change. But for the time being, having broken below the 106, this should already be a resistance. So keep an eye on the 106 if ever we get a retest before the RBNZ on Wednesday, because we could find some sellers there. What else? Quick look at the metals. Still below, but we did hold in the 1950s so far in gold. 1950, 1945, and then the bigger zone for me is going to be in the 1920s. Stabilizing. We really need to get back above, well, again, 1995, 2K to get going to the top side. But I think for as long as there's the uncertainty about the debt ceiling, I would rather view this as being in a range. Silver, it did respect the 23.5, 23.40. We went down to this support trend line. So we had perhaps a quick stop run on some weak positions, but for the time being, we are broadly holding here, 23.35.50, call it. That's going to be your level of measurements right now. And as we were already showing, and has already been shown a couple of times over F.A.C.E as well, I think this is going to be pretty important. It's middle of that range or triangle, or however you may call it. But I think 22, if it would break, there's a chance to go and or a risk to go and have a look at low 22s. That is a possibility. Yeah, quick look on stuff that has broken, and yeah. So last week I went out of my dollar China because of the PBOC, and because we couldn't hold this 50% here of the move lower, October down to January was a big setback. The 50% is at 703.75, but we are already back above after the G7 and those Micron and whatever that's going on the geopolitics. There is a meeting planned, I think, in the US between one of the Chinese trade ministers and I don't recall the US person. I don't recall his name right now. So that's probably going to be a driver for after their meeting. But yeah, it's basically 699.5, 7. That's going to be your big thing. If we start to get back below 699, then there's really a chance of getting lower here. But for as long as 7 holds, possible to go and have a look, perhaps retest where we were here, 707.5, 708.5, and then 712s perhaps, if things don't improve. And as we were saying, there may be a few positives here and there, but there's absolutely zero positives on the Taiwan question. Chinese have already rejected possible talks about Taiwanese sovereignty again, and they told the Americans it was a Chinese affair, not an American affair. So I don't think there's going to be any more progress there. Dollar rand still strong, but this morning I was trying to look for a reason why we went down 1.5%. This 1950 is now really starting to be a tough nut to crack. Yeah, Craig was showing a I don't recall where this trend line was here. This trend line, not sure whether it really works very well because it's already cut down through a few things, but it could be there, and it could be one of the reasons why, because it's pretty parallel to the prior one over there to the left. It could be one of the reasons why we are capped here at 1950. On the other hand, I reckon that people who took this level, this move, are quite happy to take profits around 1950. There may be something over there, but to me, for the time being, I'm not changing my view. I'm letting some go when I get moves up there, and then buying it back for as long as, first of all, the 19 here holds around 19. We've been briefly below here, but we rebounded strongly that level, and then mainly that level. My global view on the rand hasn't changed, and I think we're on our way to 19.75 or 20 later on. Let's see. And that's about it for now. Oh yeah, on the MEX. So we had this standstill on the Banxico, and I said perhaps there's a bit too much positioning right now in the MEX, and we're seeing a bit of weakness in the MEX. I think it may be because the market is looking at the Banxico to stabilize now. For how long will it last? That's the big question, because the Mexican peso is still an 11% currency. You can't really be short Mexican peso for too long, and the talk of the town is still that people are piling into Mexico right now. So we are correcting, and then we'll see where this thing can take us. It could already stop around 18, sorry. But never say never. There may be a case of a little higher correction here. But if you look at the overall trend, it's still going to be very much corrective. And that's it for me. Ali, I already covered gold.
Thank you very much. Thank you very much. Yeah, just to quickly go back to Ali's question, saying that it hurts when market goes just close to our take profit and then comes back and hits our stop. There's always different aspects to this. Firstly, there's shit happens. Okay, so if you're in bed, you're asleep, you're not at the desk, and you've set a TP and it gets down there, doesn't quite nick it and bounces or whatever way it goes, that's just trader's luck. That's the way it goes. You can't do anything about that. There are solutions. If you're doing something like that and your broker allows it, you can have a trailing stop. Let's say you're short with Aussie dollar at 67 and a 66 profit target. Well, you can set an automatic 30 pip trailing stop at some brokers. So every time the price moves down X amount, your stop will stay 30 pips further down or away from the price. So if you don't quite get your move and it bounces, well, you've got a trailing stop 30 pips behind the price. So you get something in there. If you are in front of your desk and you've got a 66 profit target and the price gets down to 66.10 and you start to get a little bit twitchy about what to do, we'll take some or half or 3/4 of the profit at 66.10 and leave the rest on your target and lock in your stops again. That way, if it bounces from there, you've taken money off 5-10 pips away from your target. You've put it in the bank, so you're not going to give back all that profit. That's why we do the slice and dice. For me, in Aussie dollar, I've been short from 68. So the fact I missed my profit target by half a pip not going to kill me, because my last slice, I think, was 66.48. So, okay, I've missed 30-40 pips potentially. That's not going to kill me. It would have been nice to put it in the bank, but it's not going to kill me because I've taken profit already. So even if it bounces, my stop's in profit as well. Okay, I'll give a bit of the profit back, but I'm not taking any losses. So there's various ways of doing it. As I say, leaving trading stops is one aspect, taking some money off as you get close to your stop. At least it puts some in the bank. Anyway, I hope that gives you a bit of advice how to move forward with that. And we can always discuss that at another point. Thank you, Kay. Thank you, Stel. Have a great day, everybody. Great week. And we shall see you all bright and busy tomorrow. Cheers, guys.
Thank you, Ryan. Go on the hammers.
Come on,
See you all in the chat room.
Uh,
Bye-bye.
So, yeah.